Vuk Vukovic, thank you for being back here with us. Let's talk Fed policy. The rate, it's down 25 basis points. That came yesterday. How are markets reacting?
So it was expected. It was priced in ever since the Jackson Hole meeting, which is when the last time when we talked about this. So it was priced in, and so because of that, you had sort of a mixed reaction initially. I mean, you had like a vol unclench initially when it happened, but then it was all up to kind of Powell's. Everyone's waiting for Powell's speech, because if you saw the dot plots, the Fed was basically projecting 3 cuts up to the end of the year. This was like a little bit more than last time when they were projecting 2 cuts, but still, kind of markets expected this. So it was not really a sort of a, it was not really that much of a bullish event, to be honest, in that sense, right? And especially as Key came on and started talking, Stagflation started talking about the labor market not being as robust as it was, and about inflation being a threat, an upside threat. So that kind of sent a mixed signal.
And let's talk about that stagflation, because Powell really did have a different tone, the dovish tone, or away from that rather. So what does this mean, given where the market is, that stagflation is here to stay, and yet we're cutting rates?
Yeah, absolutely. I mean, a great question. I think, like, if you look at from the reaction of the market, the bond market is what I'm specifically focusing on, right? So if you look at, so typically when you cut rates, when the Fed cuts rates, yields should go down, right? Because the yields are adapting to that. And if you look at the 2-year, it went up, and the 10-year went up. The 10-year is now above 4.1, 4.12 or something. The 2-year is almost at 3.6 again. So that means basically the bond market was overpricing, I would say, the Fed cuts. And now at this point, they're basically adjusting them back up, meaning that the bond market doesn't believe the Fed to be able to cut it 2 or 3 times because of the stagflation pressure. So that's why you had this situation where, and that's the divergence. So you have equities going up, on the other hand, bond yields going down. So bonds going down, which is weird. So I would say that this is kind of setting us up for a correction in equities potentially.
So how does what happened yesterday change your medium-term outlook?
So the medium term is still bullish. I would say it's unchanged, just because of the different the elements of market flows and the elements of policy being accommodative. So we're still in that situation for fiscal policy being accommodative, monetary policy. So we're expecting the president and the administration to change the chairman soon, or at least not soon, but like waiting until his terms end. But basically already announcing that there's going to be a new chairman with very loose monetary policy. I mean, you saw yesterday the new member of the FOMC. He was the one. So his dot plot was very low, so he was expecting 100 basis point cuts basically at this point. So that gives you kind of a signal where the Fed is gonna go, which is on the other hand very stimulative. So it should be the bullish element is there. Whether or not we do get a correction is anyone's guess, obviously. But I think like the medium-term outlook isn't changed.
And the political pressure that you're talking about, the Fed is supposed to be an independent entity that is, not governed by voters. However, political pressure is real. And like you mentioned, the new Fed governor and his opposing position that was more in line with Trump's. How does this play out at the next meeting, given that midterms are coming up as well, and we have a policy meeting, FOMC meeting in October and then again in December?
So by the time we get to the midterms, we're already going to have the new Fed chairman. We're already going to have the new type of policies, and markets are already kind of expecting this, pricing this in for the long haul, right? So over the next year, essentially, that the Fed is going to be very accommodative for because of this is the policies that the administration wants to implement. So it's always a question of like, yes, political pressure obviously is there. The president and the administration, they would want the Fed to cut sooner rather than later, because this helps them immensely. But on the other hand, I think like a lot of this pressure is kind of, it's not that dangerous as it was initially thought. So like, obviously, attacking Fed independence is a huge problem. If that were to happen, if that was the actual case, I think our markets would plummet at that news. Like people in the Wall Street community would rally against that essentially, and Trump realizes that, Besant realizes that, and they're not going to push it that way. So they're not going to go. So that's one of the reasons why the president is reacting the way he is. Right? Otherwise, if he had the power to just change everything right now and do whatever he wants, he would do it. But he can't. That's why he's expressing his outrage on Twitter or on whatever, Truth Social or somewhere. Which tells you basically that political influence is not as problematic or dangerous as we initially thought.
So, do you think this rate cut has more to do, and again, it was not unanimous, but we know that the Fed has a dual mandate, employment and 2% inflation, that this had more to do with employment and jobs numbers?
Well, definitely. I mean, that was one of the reasons what they signaled at Jackson Hole already. The reason why they're starting the cuts again, because they're concerned about the labor market. And Powell was very clear yesterday when he said that the labor market is no longer as robust as they initially expected. We had the jobs revisions. We're talking about 900,000 jobs that were revised down from what we were previously thinking. So the labor market clearly is in some kind of a, it's not as strong as it was. It's still not problematic. So unemployment is still, below 4.5%. So it's still not a big deal. But because of this dual mandate thing, so they're keeping an eye on inflation and keeping an eye on employment. But there's upside risks to one and downside risks to the other, which means that that's the stagflationary signal, and that's what got, I think, bond markets worried.
And no perfect outcome either way.
No, it's true. I mean, so this is one of the reasons why the administration wants to push the stimulus, because they're thinking, the economy is being, if there is a stagflationary scenario, we should do stimuli. On the other hand, it doesn't help with inflation, which also explains to you why gold has been such a fantastic performer this year, right? Because, you're basically switching. So if bonds are not a good hedge, if equities are booming, right? But you need a hedge in your portfolio, and bonds is becoming one.
Crypto too, for that matter.
Yeah, absolutely. So, but these are risk assets, right? So you need something as a hedge against. So you can make a lot of money on the the risk assets, and then you need to put something to counterbalance that, right? Bonds were not a good risk hedge since 2021, 22, right? Since inflation started.
So, end of the year, we're almost there. It's September now. We have October and December, the final two FOMC meetings. What do you think is going to happen? Can you predict the future for us?
Well, I'm going to try. So I would say my view is kind of in the short term, we get over the next 2-3 weeks, we get a slight correction. I don't know how much. We can be a couple of percentage points, and this kind of sets us up for a push until the end of the year. I think that's a realistic outcome. I mean, maybe it doesn't happen, but I would, if I would put my money on that. We don't do it as a fund that way, but personally, I would put my money on that scenario.